A striking shift in global energy dynamics. China's declining imports of U.S. crude oil. In a notable realignment of global energy flows, China's imports of U.S. crude oil have dropped by nearly half, signaling shifts in the country's energy priorities and broader changes in world oil markets. According to recent data from Keyplay, China imported just 81.9 million barrels of U.S. crude in 2024, a sharp decline from 115.6 million barrels in 2023, a staggering 46% decrease. Consequently, China has fallen from being the second largest importer of American oil to the sixth largest. Below, we explore the key factors driving this dramatic drop and its implications for the global oil landscape. China's evolving oil import strategy. China, the world's largest oil importer and second largest oil consumer, has historically relied on a diverse range of suppliers to meet its immense energy needs. However, recent reports indicate a 7.2% year-on-year decline in overall crude imports, a trend driven by intermittent COVID-19 lockdowns, high domestic inventories, and scheduled refinery maintenance. Despite the downturn, Beijing has recalibrated its procurement strategy, focusing on securing supplies under more competitive or flexible terms. Official customs data suggest a deliberate pivot away from certain Western suppliers, reflecting a broader effort to ensure cost-effective imports while reinforcing its energy security framework. This multi-pronged approach highlights China's determination to adapt to evolving market conditions and geopolitical pressures. The appeal of discounted crude supplies. Recent data from Claire Analytics reveals that the share of China's seaborne crude sourced from Russia, Iran, and Venezuela has risen from 24% to 26%. Though the percentage change appears modest, it represents a significant increase in volume given China's immense import base, which often exceeds 10 million barrels per day. Russia, under Western sanctions, has been offering steep discounts on its Urals crude, making it an attractive option for Chinese refiners seeking to lower feedstock costs. Similarly, Iran continues to supply crude to China despite U.S. sanctions, employing tactics such as disabling transponders and engaging in ship-to-ship transfers near Malaysia or the Persian Gulf to obscure the origin of shipments. In Venezuela's case, strict U.S. sanctions require creative payment arrangements and the involvement of third-party intermediaries. Nevertheless, the deeply discounted prices appeal to China's cost-sensitive teapot refiners. Collectively, these discounted supplies not only compensate for declining imports from Western producers, but also deepen China's ties with politically isolated oil exporters. Key drivers of realignment. The shift towards sanctioned or heavily discounted crude suppliers stems from a blend of economic and geopolitical motivations. 1. Economic incentives. By purchasing crude well below global benchmark prices, Chinese refiners secure favorable margins, which can support domestic fuel subsidies or boost refined product exports, particularly to Asian markets. 2. Energy security. Diversifying suppliers reduces China's dependence on any single producer or region, minimizing vulnerabilities to geopolitical disruptions. 3. Geopolitical strategy. Strengthening trade and diplomatic ties with nations like Russia, Iran, and Venezuela enables China to counterbalance U.S.-led sanctions. This approach positions China as a global player willing to operate independently of Western influence. Implications for the global oil market. China's strategic shift not only alters its own import patterns, but also reshapes the global energy landscape. As Beijing deepens relationships with discounted suppliers, it underscores a broader trend of geopolitical realignment in the oil market, one where traditional alliances give way to pragmatic, cost-driven decisions. Tracking and trade dynamics. The flow of sanctioned crude oil to Chinese shores is marked by complexity and subterfuge. Analytics firms like KLA Vortex and others employ satellite imagery, automatic identification system (AIS) data, and port filings to track vessel movements. These data points uncover methods such as disabling AIS transponders and performing ship-to-ship transfers, particularly near Malaysian waters, to obscure the true origin of cargo. Official Chinese customs data often fail to fully account for the volume of Iranian and Venezuelan oil, as some shipments are misclassified under origins like Malaysia or Oman. Despite this obfuscation, The growing influx of these imports highlights a deliberate policy to capitalize on pricing differentials. A 2 percentage point shift in import origins might seem minor, but given the scale of China's energy needs, it represents billions of dollars in redirected trade and a significant reshaping of global shipping lanes. This trend also applies price pressures on traditional suppliers like Saudi Arabia, Angola, and Brazil, who are occasionally forced to reduce official selling prices to maintain their market share. Wider consequences for global oil markets. China's shifting import patterns have far-reaching implications for international energy dynamics. The rising share of discounted crude from sanctioned nations exposes the limitations of Western sanctions and underscores the loopholes that allow oil flows to persist. By selectively purchasing lower-cost grades, China can influence global oil benchmarks and affect market sentiment, especially if this behavior continues. For established oil producers, China's pursuit of bargains pressures them to adopt more competitive pricing strategies, resulting in changes to supply routes and contract terms. This dynamic is particularly challenging for Russia, a key member of the OPEC Plus alliance, whose discounted sales to China can undercut the cartel's efforts to maintain high price levels. On a broader geopolitical scale, China's deepening ties with sanctioned oil exporters like Russia, Iran, and Venezuela may shift international alliances. These relationships bolster Beijing's position as a major energy consumer willing to operate outside Western norms, enabling it to secure low-cost energy while expanding its leverage in global trade and diplomacy. This strategy could pave the way for more substantial changes in global energy markets and international relations. The rise of electric vehicles and renewables. China's rapid adoption of electric vehicles, EVs, is poised to reshape oil demand. As more consumers switch to EVs and the government continues to push for electrification in transportation and industry, the country's long-term reliance on oil imports is likely to decline. In addition, the growing availability of cleaner energy sources, such as liquefied natural gas, LNG, is gradually displacing crude-based energy solutions. This shift complements Beijing's broader strategy to enhance energy security and diversify its energy mix. Strategic economic alignment with Russia and Iran. China's strategic economic partnerships with Russia and Iran have significantly altered global energy markets, especially in the context of Western sanctions. After Russia's annexation of Crimea in 2014, Western nations imposed sweeping sanctions, prompting Russia to pivot its energy trade toward Asia. This partnership deepened following Russia's 2022 invasion of Ukraine, which led to unprecedented sanctions. In response, Russia offered energy exports, particularly crude oil, at steep discounts to China. By 2023, China-Russia trade hit a record $240 billion, with energy exports forming a substantial share of this exchange. Notably, in 2024, China completed the Power of Siberia gas pipeline, further strengthening its access to Russian natural gas. This infrastructure underscores the growing energy interdependence between the two nations and their shared strategy to counterbalance Western economic policies. China's energy relationship with Iran. China's energy ties with Iran have been shaped significantly by international sanctions. Despite U.S. measures aimed at restricting Iran's oil exports, China has maintained its imports of Iranian crude, often at heavily discounted prices. This trade not only provides China with cost-effective energy resources, but also offers Iran a critical economic lifeline. In October 2024, the U.S. imposed additional sanctions targeting Iran's petrochemical and oil industries. These measures were designed to limit Iran's financial ability to support missile programs and related activities. Thank you for engaging with this content. If you're enjoying it so far, we'd greatly appreciate your support. Liking this post helps us reach a wider audience, and sharing your thoughts or feedback in the comments makes an even bigger impact. Thank you for watching. Now, let's dive back in. Implications for U.S.-China energy trade. China's deepening energy ties with Russia and Iran have significant implications for its energy trade with the United States. The availability of discounted oil from these sanctioned nations provides China with more economically attractive alternatives, potentially reducing its reliance on U.S. energy imports. This shift is further driven by geopolitical factors, as China seeks to diversify its energy sources and lessen its vulnerability to Western political pressures. Geopolitical and economic considerations. China's engagement with Russia and Iran extends far beyond energy trade, encompassing broader geopolitical and economic strategies. By strengthening ties with these nations, China aims to counterbalance Western influence and enhance its strategic autonomy. This strategy aligns with China's ambitious Belt and Road Initiative, which seeks to expand its global economic and political influence through infrastructure development and trade partnerships. Impact on the U.S. economy. The decline in U.S. oil exports to China could have ripple effects on the U.S. economy. A reduction in exports may lead to an oversupply in the domestic market, potentially exerting downward pressure on oil prices. This scenario could hurt U.S. oil producers, leading to reduced revenues, diminished investment, and job losses in the sector. Moreover, a sustained drop in exports to China could contribute to a widening trade deficit, affecting broader economic indicators. These shifts are influenced by the complex interplay of geopolitical tensions, trade policies, and the ongoing U.S.-China trade war, which has been marked by tariffs and trade barriers. These developments have encouraged China to diversify its energy imports, reducing its dependence on U.S. oil. China's oil import journey, a testament to economic transformation. China's evolving energy trade reflects its rapid economic transformation and growing global influence over the past 4 decades. From being a net oil exporter in the early 1980s to becoming the world's largest crude oil importer, China's trajectory highlights the intricate balance of industrialization, energy security, and geopolitical strategy. The shift began in the early 1990s when China transitioned to a net oil importer in 1993, driven by rapid economic reforms and industrialization under Deng Xiaoping's leadership. As domestic energy consumption surged, domestic production, primarily from fields like Docking, struggled to keep pace. This shortfall necessitated imports from nearby regions like Southeast Asia. By the early 2000s, China's energy demand soared, fueled by its accession to the World Trade Organization (WTO) in 2001 and an economic boom heavily reliant on manufacturing and infrastructure development. Oil imports grew steadily, exceeding 4 million barrels per day by the decade's end. This period also saw the construction of critical infrastructure, including pipelines and refineries, laying the foundation for handling even greater import volumes. China's evolving oil import landscape. The 2010s marked a decade of unprecedented growth in China's oil imports. By 2017, China had surpassed the United States to become the world's largest crude oil importer, a milestone driven by surging industrial demand and an expanding consumer base. To reduce dependency on Middle Eastern oil, China diversified its import sources, significantly increasing purchases from Russia and Africa. By the end of the decade, imports stabilized at around 10 million barrels per day, cementing China's central role in the global energy market. Resilience amid the pandemic. The global pandemic in 2020 disrupted economies worldwide, yet China's oil imports remained resilient, averaging approximately 11 million barrels per day. A key factor behind this stability was strategic stockpiling, as China seized the opportunity to buy oil at low prices to bolster its reserves and ensure long-term energy security. In the following years, oil import levels fluctuated due to adjustments in domestic demand and the lingering effects of COVID-19. Despite these challenges, China's imports hit a record 11.3 million barrels per day in 2023, propelled by a robust post-pandemic economic recovery. Strategic shift in energy policy. China's decision to reduce or eliminate oil imports from the United States, while strengthening energy ties with BRICS nations, particularly Russia and Iran, reflects a deliberate shift in its energy and geopolitical strategy. This policy underscores China's focus on energy security through diversified suppliers, cost reduction by leveraging discounted oil, alignment with strategic allies within the BRICS framework. This realignment, however, poses significant economic and geopolitical challenges for the United States. Implications of China's energy realignment. China's pivot away from U.S. oil imports aligns with broader BRICS initiatives to establish a multipolar global order, challenging the dominance of Western-led systems. The Western sanctions on Russia following the Ukraine conflict have created opportunities for China to access heavily discounted Russian crude, further incentivizing its shift. Simultaneously, China has expanded its energy imports from Iran, achieving greater diversification across continents. This strategy not only mitigates risks associated with U.S. trade policies or geopolitical tensions, but also strengthens China's energy independence. By embracing such a diversified and cost-effective approach, China reinforces its position as a global energy powerhouse while aligning its economic strategies with its geopolitical ambitions. Economic and geopolitical implications. From an economic perspective, discounted oil from Russia and other BRICS nations allows China to meet its energy demands more cost-effectively. These relationships also enable China to bypass the dollar-dominated global oil trade, potentially conducting transactions in alternative currencies like the Chinese yuan. This move directly challenges the petrodollar system, a key pillar of U.S. economic influence. The decline in U.S. oil exports to China is set to disrupt the U.S. energy sector. Historically, China has been a major market for U.S. crude, and its reduced demand could lead to an oversupply in domestic markets. This, in turn, risks depressing crude prices, squeezing profit margins for American producers, and curtailing investment in the sector. The ripple effects may extend to job losses in energy-dependent regions and a slowdown in related industries, including logistics and refining. Geopolitical repercussions. China's energy strategy also diminishes U.S. influence in the global energy market. By strengthening ties with BRICS nations, China is contributing to the creation of a parallel economic framework that challenges U.S.-led systems. This shift aligns with BRICS's broader ambitions to establish alternative financial systems and reduce dependency on the U.S. dollar. The reduced reliance on U.S. oil exports weakens a crucial lever of American economic diplomacy. Furthermore, the loss of Chinese demand may exacerbate existing U.S. trade imbalances, particularly as energy trade has historically been one of the few areas of positive economic engagement between the two nations. Complicating matters, the growing adversarial tone in U.S.-China relations makes it increasingly difficult to mitigate the economic fallout of this policy shift. Thank you for watching this video. We sincerely appreciate your time and support. If this content resonated with you or sparked new insights, please consider showing your support by liking this video and subscribing to stay connected with our community. Your engagement means the world to us. Ready for more? Check out another video from our channel, now appearing on your screen.